All right, thanks, Quinn, and thanks everyone for joining us today. We're doing this topic really because the recent volatility in bonds has been a big change to what investors have been used to. And this year, at its worst, a total bond fund, which is really some of the most popular types of bond funds out there. These are funds that own thousands of different bonds of many different types. So, treasuries, corporates, mortgages, etc. Was down about 15%. It's bounced back a little bit since, but at its worst, this is the decline that an investor in a total bond fund was looking at earlier this year. And just to give you an idea on how unusual that is, prior to this year, the worst annual performance for a total bond fund over the last 35 years was a 2.7% decline in 1994. And so certainly in kind of unusual territory. But problem is in quotes in the slide here, because for a long-term investor, this isn't necessarily a problem. Obviously no one likes to see their account values decline, but for a person that has time to hold, these total bond funds now are buying higher interest rate bonds, which will actually increase your returns in the future. And so, rising interest rates are actually a long-term benefit for you. But this does get, potentially unsettling for maybe a retiree withdrawing from their accounts. And if you have a certain need for money in the short term, this is an example for why a typical bond fund might not be the best choice. If you need $50,000 next year, it might not make sense to have that $50,000 in something that can drop 15% very quickly if interest rates rise. And so why did this drop occur this year? Why are these bond funds potentially not the best place to keep money that's needed in the short term? I'm going to do a very simplified and quick example here, but if you want to understand a little bit better about how exactly bond prices change as interest rates go up and down, we did a webinar previously titled "What's Going On in the Bond Market" that you can look, where we talk about this in a little bit more detail. But just to use a very simplified example, say you buy a bond for $100 that has a $5 annual coupon or has a 5% yield. If general interest rates rise 1% after you purchase that and are now, 6%, and you try to sell this 5% bond, no one's going to want it at $100 at the price you paid for it, because they could get a 6% bond anywhere else. And so you're going to have to offer it at a lower price if you want to sell it. And that price is going to be where a $5 annual payment equals a 6% yield. Because that's what investors can get anywhere else. And so, just for example here, I showed that this bond, again, very simplified example, but you might expect it to fall to about $83 instead of $100, because there, that $5 payment, it gives that new investor about a 6% yield. Exactly how this works is a little bit more complicated, because in the real world, there's another characteristic of bonds, and that is that upon maturity, you get your principal back, or the face value of the bond, or $100 in this case for our example. And so as long as the issuer of the bond doesn't default, no matter what interest rates do in the future, this bond is going to eventually go back to $100 or whatever value it's going to get redeemed at. As long as the investor holds this bond until maturity, they will get that $100 back. But most bond funds don't operate this way. And typically most bond funds that investors use don't operate this way. For example, Schwab has an aggregate bond fund shown here that we use for a lot of client accounts. And it's never going to mature at a certain date like that bond will. You're never going to get a chunk of your principal back. Really what Schwab is doing here as bonds mature is that they're reinvesting them into new bonds. And so this fund owns more than 8,000 bonds at any given time. And just as they mature, just buys new ones to kind of replenish that. This is a very good thing for those with longer time horizons who are comfortable with volatility. if you don't need this money that you've used to invest in this fund, you want it reinvested in the new bonds, you want it continuing to grow and compound. But for a person that has, fixed cash need, you don't have the certainty of getting that principal back like you do with the individual bond, or also like a bank CD, another popular investment used by a lot of retirees. And so, all this is the reason that investors have used what's called ladders in the past. And this is nothing new. I think this has been around forever, but typically ladders have just been created using bank CDs or individual bonds. They will set up holdings that mature at a certain time to meet anticipated cash needs. So you might buy a 1-year CD for next year's cash needs, 2-year CD for 2 years for your cash needs 2 years from now, and so on. And this type of laddering reduces interest rate risk because you have assets that are maturing at a certain date. You know you're getting your principal back at a certain date. You don't have to worry about a bond fund potentially being down 15% temporarily and selling it and, kind of selling at a loss, not having as much money as you expected. I think this concept of laddering is pretty familiar, so I'm not going to go into a lot of detail here. But what is worth discussing is how these ladders that are done today, how they're done today, and some downsides to doing them with things like bank CDs and individual bonds, which have typically been used. And so with bank CDs, for example, specifically today, interest rates are just really low. Banks don't really need customer deposits right now. They all have more cash than they know what to do with. So there's no real incentive for them to offer higher rates like we've seen sometimes in the past. And just to give you a general idea of interest rates that are available right now for bank CDs, this is a screenshot here of something that Nick puts together for us every month that shows CD rates at local banks and credit unions around the area. And you'll see that barring certain specials that are out there, interest rates are really low. A 2-year CD at Green State has a 0.4% interest rate. And just to compare that, today a 2-year treasury bond, something we can very easily buy for you at Schwab, something very safe, guaranteed by the federal government, has a 3.2% interest rate. And an investment grade corporate bond, which has some risk, but a bond issued by a company still in very good financial shape, has a yield somewhere around 3.8% on average. And so just right now, bank CDs, if you're setting up some kind of ladder, really have much lower returns than you can get elsewhere. And besides interest rates, CDs also have penalties for accessing the money early typically. And this could just be another reason why they aren't ideal for retirees with, maybe variable expenses or who don't have or don't keep larger cash cushions elsewhere. And so the principle of using CDs is very good for bond ladders, but today especially just doesn't make a lot of sense. Another option is using individual bonds. This is popular for some and probably in place if you've worked with a broker before. That's just someone who's paid commissions for selling bonds or other investments, instead of like a fee-only planner like we are. This is another strategy that works well in principle, but is hard to implement correctly in a real portfolio. And just to show why that is the case, I thought it'd be good to show you what we see when we go in to buy an individual bond for a client. So here I just did a search in Schwab for bonds that have a maturity for about 2 years from now and are investment grade. And so I know there's a lot of info on here and it's busy, but what you see here is a list of individual bonds for sale. You see the company issuing the bond. So this top one here is Credit Suisse, a big international bank. You see the coupon of that bond, 3.625% in this case. You see the maturity. This is the day you get your principal back. But another thing I want to point out here is the minimum trade size required for some of these bonds that are out there. In this case, you see 250 for this top bond. This means that at minimum right now, the smallest order they're accepting is 250 bonds. Each bond has a face value of $1,000. that means your minimum purchase is $250,000 for this bond. And I feel pretty comfortable saying that most people here, don't want to invest $250,000, likely a big portion of their net worth in one single company bond. And so it gets really tough to diversify when we're looking at setting this type of ladder up with a client. It gets really hard if we just have, $20,000 or $30,000 to spread that money across a lot of different companies like we would like to do to keep you diversified. And then in addition to that, just the trouble diversifying, in general, corporate bonds are just really not traded that regularly. And so we risk getting you invested in something that has really poor liquidity. And so again, just for example, on a couple of these bonds that we looked at, two things that we look at is the bid-ask spread. So this is the highest price if you're trying to sell a bond right now, and the lowest price if you're trying to buy a bond right now. And you'll notice that spread is just it's kind of like a charge that the market charges you if you want to trade this bond. If you buy it for $98.44, you're not going to be able to sell it for that price right now. You're going to have to reduce your price to get someone to buy that right now. Typically, this isn't an issue with stocks. This spread is, a cent or even less. But for bonds that aren't traded a lot, the spread gets really big. And the reason that is because these bonds just aren't traded. There's not a lot of active demand. And so this bottom image here just shows this bond, which is issued by, a very well-known international bank, literally trades a few bonds a day, some days without any trades at all. And so if you buy this bond as part of your ladder and need to sell it before it matures, you need to be, either comfortable with it taking days to sell, or you're really going to have to lower your price. You can see here, even lower than kind of current bids for these bonds. You're going to really have to lower your price if you want to sell this bond right away. And so again, we think this is a big issue for money that you're setting aside for short-term needs that you want to make sure is safe and liquid. And just another reason why we don't use a lot of individual bonds with clients for this purpose. And so what's an alternative to either CDs or these individual bonds? It's a relatively new idea called a defined maturity bond fund. And what it's doing is trying to combine the good characteristics of individual bonds. You want that maturity at a set date, getting your principal back, but then with other characteristics of ETFs or mutual funds that make it very easy to diversify, have much better liquidity. And so these are funds that only purchase bonds that mature in a specific year. And then at the end of the year, that fund does not reinvest the proceeds of the maturing bonds like a total bond fund does, but instead gives the investors the principal of the maturing bonds back. And so it acts like an individual bond, in that sense. You're going to get your principal back at a set date. But a benefit is that instead of just holding one individual bond, it holds hundreds. These funds have hundreds of millions or billions of dollars in assets. They can properly diversify, unlike an individual investor trying to navigate the individual bond market that we just looked at. These funds have no problem holding, meeting those higher minimums, holding these bonds for a long period of time. And these funds also have intraday liquidity. They trade just like any other stock or ETF. There's big markets for them. You can hit sell in your brokerage account. They'll sell nearly instantly for very little spread. Potentially waiting days to sell is not a problem with these. And then lastly, there's a lot of types of these funds available that make it very easy to build a portfolio that suits your needs. And so there are defined maturity bond funds that hold treasuries if you want the safest investment out there. There's defined maturity bonds that hold corporate bonds if you want to, hope to get that higher return that corporate bonds have, but still diversify, across hundreds of different companies. There's municipal funds also for those where municipal bonds make sense due to their tax situation. Just a lot of flexibility in implementing these into your financial plan and tailoring it to what you need. And so what does one of these funds look like? For a specific example, here's a fund by BlackRock, the ticker symbol IBDP. It's called the iShares December 2024 Term Corporate ETF. And as you can probably tell from the title, this fund owns corporate bonds that all mature in calendar year 2024. And the fund will actually liquidate on December 15th, 2024. So one big concern with investments is always expenses. The good thing about these is that they're very easy to manage. They don't take a lot of active management. They have, in general, very low expense ratios. BlackRock or their iShares line are all 10 basis points for their corporate bond ones, or 0.1%. These funds also have a lot of assets. This one in particular, about $1.5 billion, which again just allows it to very easily diversify into many different bonds. In this case, it owns 538 different individual bonds. And you can see this is, that's a great improvement over an investor using individual bonds who can maybe only really effectively own 3 or 4 bonds when they're building their bond ladder. And then, as we said, this fund will liquidate in December of 2024. So you can be certain that you're going to get a payment on this date, and that the fund is holding all the bonds in its portfolio until maturity, ensuring that they get that par value of the bond back. And perhaps best of all, with the recent rise in interest rates, especially, these offer a relatively good yield. And right now, as of yesterday when I checked, just under 4%, about 3.9% for this specific bond. And that's the yield to maturity, which I wanted to spend 1 minute just explaining that term, yield to maturity, because it might not be something you're familiar with or we've covered in the past. It's really just a calculation of your annual return if you hold the bond, or in this case, the bond fund, until it matures. And so remember from our example before, a bond that might have dropped from 100 to 83 will then mature at $100. And so if an investor purchased that bond at 83, they're going to get that interest payment, that coupon payment every year, but also get a return on their principal. That 83 is going to turn into 100. Yield to maturity calculates the return not only from the interest payments, but also any gain that you would get in the principal once the bond's redeemed. And so for this fund in particular, what we're looking at here is just kind of the fact sheet of that 2024 corporate bond fund. You can see the average coupon of a bond in its portfolio is about 3.1%, but the yield to maturity is a little bit higher, 3.87. And so that difference there shows you that some of these bonds now are trading below par value, and that when they mature, you're going to get that $100 for using our previous example back. You're going to get a little increase in your principal also. And so, if you do want to consider these defined maturity bond funds, the yield to maturity is probably the important number you want to look at, because this is essentially the return you're locking in when you purchase the fund. If you hold this fund into maturity, you will get somewhere around 3.87% annualized return. If you're expecting something higher, or want to gamble, hope you get something higher, you're not going to get it if you buy this fund and hold it to maturity. So this is really a number you want to be comfortable with before you buy this fund. And then just to summarize one reason why we think these make sense today compared to laddering with CDs, we kind of showed this earlier, but just to reiterate here, here's the current yields to maturity for both a Treasury defined maturity bond fund and then a corporate one. And then comparing that to Green State's, special for their 15-month CD that they have right now, that's 2.5%. And so this is, at 2.5% is the highest rate of any CD Green State offers. So I'm not cherry picking a low rate or anything like that. And you can see even that is still below what you can get with some of these defined maturity bond funds, even US Treasury bond funds that, again, guaranteed by the government, the same kind of risk level as a CD really, can still get a much higher return. And so, it's really easy to put this type of ladder in place. There are defined maturity funds available for every single year for the next 10 years out. And so, I think the basic idea of building a ladder is pretty well understood. You can select, a 2023 defined maturity fund, a 2024, 2025, and so on, and build that ladder in the same way, but get a little bit higher returns than what you can get on a CD, and a little bit better diversification than if you just used individual bonds. And so, of course, there's pros and cons of everything. We think these have a lot of pros, especially compared to CDs. But there are a couple other things to be aware of, if you decide to use these investments. We mentioned at the start that the issue with bond funds is their volatility. And for some, the recent volatility of bond funds has just been a little too much than they're comfortable with. But for investors who the volatility doesn't really bother them, they're comfortable holding through this volatility. Historically, you've been rewarded by the market for accepting that volatility. And, again, historically, using past returns, which are no guarantee of the future, though, a total bond fund has outperformed today's defined maturity bond funds, or the interest rates on defined maturity bond funds today. And so, again, we don't know what the future holds, but if it's like anything in the past, a total bond fund has returned just under about 6% annually over the last 35 years, which is, a good jump in performance from what you can get in some of these defined maturity funds today. And then what I thought was interesting too, the best annual performance of a total bond fund was about 18% gain in 1995. And perhaps not coincidentally, that occurred the year after 1994, which was the worst year for a total bond market before this year. And so, again, if you can hold these funds for longer periods, they have historically worked out. You've gotten good returns, especially after a period like we're experiencing now, have a relatively big drop in these funds. And so just know that there is a potential for lower returns using these defined maturity funds. You get that reduction in volatility, but you could be giving up some gains too. And while if you have a plan to hold these funds until maturity, you can be confident getting a good chunk of principal back, but you're still going to see the volatility in the day-to-day share price of these funds. Again, they trade during the day like any other stock or ETF. And so you will see some potential rise and fall in the share price of this. And so, that might have the effect of still making you nervous. You can be confident that if you hold it, you'll be fine. But as you can see from this chart here, that 2024 defined maturity fund is down close to 6% right now from where it was a year ago. And so you would be seeing that still in your account statement as you look. So, this is unlike a CD that, where a CD, you're not going to see kind of these daily ups and down moves, and could be, again, just one potential reason that these aren't a good investment if you are really risk averse still. And then lastly, these funds end up effectively just being cash later on in their lives. And so remember, these funds own hundreds of different bonds that all mature in a certain year. As they mature, the proceeds are not reinvested, and especially later on, not reinvested at all. And so the funds build up a lot of cash. And essentially later on, as the fund gets closer to maturity, really what you're holding is a fund that just holds a lot of cash. And that means that your dividends are going to be lower for the last year that you hold this bond. And that also means there's a little bit of risk in you getting the return from that stated yield to maturity. And so again, a busy chart here. This is a a case study that's published by BlackRock about how these defined maturity bond funds have actually performed from inception until they mature. And so, these funds have been around for a while. And so a good number of them have gone through the cycle of being issued and then maturing. And what I really just want to point out is the bottom row in this table shows the difference in actual realized returns from an investor compared to that stated yield to maturity that you can find on the fact sheet of any of these funds. And you'll notice that it is a little bit lower typically, and that's just because that, again, these funds end up holding cash, which has a much lower return, and you might be holding cash for a long period of time with these, and obviously just don't get that return as you did when this fund owned higher interest rate bonds. And so, at most, this has not been that big of an issue. The worst year here is more recently, where the investor received about 0.4% less annualized return than what was stated. Again, we don't think that's a huge deal because even if that happens again, you're still looking at a yield much higher than CDs and other potential investments. But this is an issue where, if interest rates really drop as this fund holds a lot of cash, you could see this performance difference increase, and is certainly one risk that's out there. And so just to summarize, in the end, we don't think that every client needs these. We're not going to be recommending everyone switch to these types of investments. There's pros and cons to everything out there, but they are a good alternative for some investors. And specifically, if the recent volatility has just been keeping you up at night, we want to know about it. And these can certainly be an option that we can add to your portfolio to help at least give you some peace of mind, knowing that, a lot of people call this like the bucket approach, knowing that there's a chunk of money in your portfolio specifically designated for a certain time. And again, just to try to give you some comfort that you don't have to worry about these short-term ups and downs of the market like we're seeing now. There's some other cases too where, if you do have higher spending, maybe, we'd talk with you about this. If we look at kind of the Monte Carlo of your plan and tell you that market volatility might pose a risk, it might be a reason to kind of get some money out of the market early on, get set in kind of these fixed rate investments to actually strengthen the likelihood of success for your plan. Again, this is something that we talk about. Don't feel like you need to be the one to make this judgment, but is a reason that they can be useful in a portfolio. And then lastly, we just want to stress that these are really best for those that have set dates where they know they need a certain amount of money. If you can be comfortable investing for the long term, something like those total bond funds are going to be better because they're reinvesting proceeds, compounding, growing more. These are really for, kind of a select group of clients that have, maybe higher withdrawals early on in retirement, very risk averse in the short term, things like that. So thanks for hanging on there. I know that got a little bit longer than normal, but thank you for watching here. Please let us know if you have any questions. Again, as Quinn said, either now or next meeting, we'll be happy to talk with you about these. And if you don't have any questions, have a great weekend. Thank you.